Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of November 24th, 2024. And in this week's episode, it's going to be a quick update here because last week I played 4 earnings. They all went out on the Wednesday, and 2 of them were pretty much looking to be winners at the time of this recording. And 2 of them are looking probably to end up with management of assignment or management of a role or potentially assignment. And we'll get into what those were, or at least how they played out, but they were on NVDA, Target, Palo Alto Networks, and Snowflake. But first, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You'll also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up there, subscribe, and if you can't find it, let us know, and we will get it there. But let's hop to this week's content, and that is earnings trades. Now, and many of you might have known if you're a longtime watcher of this show, or if you've randomly scanned the backlog, chances are you have come across episodes around earnings trades because they are my absolute favorite trade to play. Why do I like them so much? Because they're fast, they can return things pretty well, very quickly. And if you do look for the right setup, they might not be that bad when they're busted and they kind of go against you, which is what we kind of have happening here today. And so, let me refresh your memory if you haven't seen them recently or you forget, what the concept here is. And the concept going into an earnings trade is I look for particular companies that are larger companies, well-known companies, profitable companies, in most cases, profitable companies. And we're looking for extended volatility or extreme volatility. And so you might be a large company, but if your volatility is not extra elevated, I'm not going to go into an earnings trade on it. I still might trade it on the options depending on, where it's at. But specifically for earnings trade, I'm looking for things with extended volatility. Why am I looking for things for extended volatility? Well, because statistically, a lot of the statement of volatility is overstated. So whatever the predicted volatility is of the particular stock, a lot of times the reality of that is less than what the market is predicting. And it's kind of like when you think a stock is very much overvalued, you sell that stock, shorting the position because you think it's going to come back down or return to a more normal level. Same thing with selling options with extended volatility. The idea is you are collecting the premium of that extra extended volatility. You wait for that volatility to come down, and then you buy back the option to close. Very, very similar to the mechanics of shorting a stock. Now, time premium or volatility of an option is also another factor. And so this is 2 things that work in your favor. The passage of time, because all options by their very nature expire to 0. So as time goes, the value in the option will decay to 0 at expiration. And then you add into that the extended volatility, and then you're looking for that volatility contraction, which typically follows a binary event. So once the event is over, a lot of the uncertainty is gone and the volatility deflates out of the underlying. And that's exactly the setup that I look for in earnings. Is I am looking for stocks that have extended volatility, and I enter them at the beginning of the week of earnings. So whatever day they have earnings, I typically try to enter at the beginning of the week, and I'm going to sell options that are going to expire at the end of the week. That way I'm as close as I can be to the expiration of the option where the value goes to 0, but I'm also coming in and grabbing a lot of that elevated volatility. Now, going into this, I usually play a strangle, which means I'm going to sell an option on the put side or below the strike or below the current stock price, and I'm also going to sell a call above the stock price. Now, I do both of these trades naked most of the time. Typically, you could add legs to that for protection. I don't typically do that for two reasons. One, in most cases, part of my prerequisite of entering is I'm okay with assignment. So I keep my positions relatively small to my portfolio balance so that if something goes dramatically against me, I can absorb that extra cost and that extra hit for taking the assignment, whether or not I'm buying the shares or whether or not I'm selling shares I don't have, effectively shorting them on the open market to the upside. And so, statistically, this works out about 70 to 80% of the time. And in the 20% of the time, I typically will lose and I will get assigned. So I want to take you through 4 trades that I put on for earnings. Now, this was a super mega day because they all reported on the same day. One was before the bell and 2 were after the bell. And so I want to pull up my Flappy Bird chart, as I like to call it, to just kind of show you visual representation of what this kind of looks like. And the first one that I'm going to pull up is going to be Target. So Target is a retailer. They reported earnings. They reported the day after Walmart. Walmart had an excellent quarter. They gave great guidance, and Walmart stock really rallied. Target shares didn't really move on the news of Walmart, and then they went and reported before the bell the following day. And so what you see here in the Flappy Bird chart is basically the stock price of Target, and this is 4-hour candles. And I'm going to zoom out just a little bit so you can get a little bit better picture of, kind of where Target is or where it's been. And you see these red bars. This is basically where I was thinking the price would stay between. So on the bottom side, it was about a 140 strike. And then when I looked at kind of the charts and the price action of where this is, I thought, okay, we're kind of not really on an uptrend. If anything, we're kind of a little bit on a downtrend here from this previous high around 180. And I thought, well, where might we come down to? And I noticed that we kind of have this level here, maybe in the mid 130s. Where we kind of had some hesitation here. We eventually kind of gained it. We fell below it. We gained it back. We kind of came up. Now we came down and we tested this and we came off this level. And so I thought, you know what? This might be a particular level of resistance. And so this might be an appropriate place to place a strike. But going into the earnings, this 130 to 135 level was a little bit too low for the delta and for the premium. So I went ahead and I took a 140 strike, which is a little bit higher. And the reason I did that was because I was going to collect premium on it. And if I got breached and went down below there, I would be okay buying Target at a 140 level. Again, there was other previous levels where it kind of bounced off this 140. So it seemed relatively reasonable. But that is not how Target panned out. So actually Target reported their earnings, absolutely abysmal earnings. They retracted guidance that they had just given 3 months earlier, and then basically gave new guidance, poorer guidance, outlook and stuff like that. And the stock just absolutely got thwacked. So I think at some points we were down 25% on the trading day. I think it ended up down 22%, something like that. I believe it was the 3rd worst trading day that Target has ever had. And so you can see that we well breached my put strike. So this is one of the cases where this just did not pan out for me. And where I'm at with this is there's still 2 trading days left this week. I will let those trading days kind of go by. Probably looking to roll on Friday is likely where I will go ahead and try to roll. I will look at the premiums to see if rolling even makes sense. But as we're almost $20 in the money here, it's entirely possible that there really won't be much premium to roll. And so if there's really not much there, like less than $1 contract or something along those lines, I likely will end up just taking assignment on this and being assigned these Target shares. And then I will go ahead and sell covered calls against them as we kind of work our way up. Now this call will print out 100%. I'll make all the money I sold on that call. But this is one of the ones where, on the downside, it's not looking so good. The other trade that I put on was NVDA. Now, this is one that I I've starting to like more and more to trade on earnings. And the reason that I like NVIDIA is because holy smokes, does this thing have volatility. You got actually on this particular chart here, you can see the previous earnings trade that I had, but it gets so volatile where this is a mega cap stock and the options were pricing in just this astronomical movement of price where there's just all this speculation that coming in and buying calls out the wazoo and really kind of ramping up all of that volatility and premium, and to the point where I feel pretty comfortable with the strikes there and the amount of premium that I'm going to pick up and the distance that needs to travel. I mean, this is one of the largest companies in the entire market cap. These things just don't move, 20, 30% like your targets or even smaller companies. Even Target doesn't even usually move that much. That was pretty abnormal move for Target. Anyway, right here on the screen, you can see what we've got going on with NVIDIA. So NVIDIA was trending down after earnings, slightly disappointing as far as their forecast, and they basically said they were kind of supply constrained. But you can see the second pair of red boxes where we're hey diddle diddle right down the middle. This is going to be absolutely wonderful. This volatility is going to contract. There's only 2 trading days left. Most of this time premium is going to be completely gone. Probably on Thursday morning. And it'll end up closing out likely for almost 100% profit here. And this is textbook. This is what I like to see when I trade my earnings. So the next one that I put on was another one of these cases of extended volatility for Palo Alto Networks. And so Palo Alto Networks, this was a larger underlying. So you can see it was trading around 380, 390. So I really couldn't do a lot of contracts here to fit my position sizing, but I was able to get one in. This thing has really kind of been on an uptrend as far as, where's it going? It's going to kind of up and to the right. Volatility was there. I think a lot of the volatility was extra kind of extended because we're up there on close to all-time highs, and that really just drives a lot of premium and stuff like that. And so where we put these strikes were about 360 on the put side and up there at about 430 on the call side. And really where I pick these strikes is I usually look about a 16 to 25 delta. Somewhere in there is really where I'm going to pick the strikes. And the 16 deltas, I often don't go that far out because the premium is a little bit less because I'm doing the week of expiration, and the closer you get to expiration, the faster the decay is on those really low deltas. 25 delta, I typically don't end up there very often unless I really have a strong bias towards direction, because 25 delta often, the price movement will encapsulate that 25 delta thing on a good number of the earnings moves that I have played. And so I end up kind of settling the difference, and I start targeting around an 18 to 20 delta strike. And so most of these are around 20 delta that I'm talking about here today. And so 20 delta is a little bit less than one standard deviation move out, but you can see the nice range that this set up as far as the Palo Alto goes. Now this red line right here, this is where the current close is. So I would say we are biased more towards my put, but look at this level that we're kind of coming off of. And so this is a level that I believe would show resistance at some kind of test. And you can see that's exactly that 360 level where that strike is. And so while this is biased to the put side, there is only 2 trading days left before those contracts expire. And we are not breached. In fact, we wicked down and kind of came back up. Of course, we wicked way up. So we'll see how that kind of goes on open. But generally, this one is looking very, very good for being able to close out this earnings trade at almost 100% winner. It's not quite as perfect as NVIDIA, but it's not that far from it. So far, we've got one where I'm going to probably end up owning the shares of Target. I'm going to collect almost all the premium on NVIDIA, and very likely Palo Alto will also come in. And that takes me to the last trade that I put on Snowflake. And so I wanted to make sure, I didn't do this on purpose, but it really seems like we decided to cover the whole gamut of things because right here is Snowflake. Snowflake You can see kind of heading in here, I decided to split this about a 20 delta again. So this brought my low side about a 113 put, and on the call side is about 145 call. This thing went in and announced their earnings, and they knocked it out of the park. And so almost the exact opposite of the target situation. I believe this thing rallied 25% after hours to just rock it up. Now, where that's going to go, I don't know. A lot of times when something shoots up like this, you'll get a reversion to a mean to some level. But this is pretty deep in the money on the call side. So this is very similar to a recent earnings trade that I had put on for Shopify, where Shopify just absolutely blasted through the call side, didn't look back, and just kept on rocketing and rocketing up. So this one, I don't know where it's going to end up, but I likely will probably end up trying to close this, potentially taking a loss, as I don't know if we get price action that kind of shows it's coming back to a mean, then that's cool. I could slide up this put, probably slide it up down here to where we kind of took off from around the 125 level. If we kind of start sliding back down, looking for a reaction off of that and kind of a continuation of the trend up. This is likely around a reversal, potential reversal here. So you can see kind of coming off these recent, back last February, I should say, mid 230s. We've kind of slid down, and we're kind of starting to maybe swing back up. Will be interesting because there is this high that was struck here in February, kind of started swinging off of this 140 level, which is why I thought my 140 call was a pretty good call strike, because this was a previous level that it kind of went up. Also, it showed some resistance here, ultimately failing, which led the stock to go lower. But this is kind of interesting to see. I'm expecting this to at least come back down and test this 140 level. So on the way up after hours, we blew right through that 140 level. Didn't really test it, so I'm kind of looking for maybe a pullback to that 140 level to kind of test and see where it goes from there. And so if we get a pullback close to that 140 level, I'm going to look to close this thing out, particularly if we hit 140 or just go a little bit below. There really will not be any time premium left. And so I'll be able to close out the call side for almost 100% at that point, which will be awesome because the put definitely could get closed out. But like I said, depending on where it ends up, I might end up pulling that put up, extending the put out probably to the next monthly to gather a little bit more premium, and then I can take a little bit more of a loss on the call side because the premium from the original put and then the rolled put should well outpower the premium lost on the call side, provided we start pulling back towards that 140 level. So what does this actually look like? From a percentage basis, from a premium collected, from a buying power consumption, things like that. And so let me just quickly run through some of these. The first one is the target strangle. This is one that I'm going to end up on assignment. So this return on capital on this time frame really isn't correct because I'm going to end up spending buying power to purchase the shares, hold the shares, sell some covered calls. So I'll keep you posted on how target plans out. If I roll it, yes, I'll collect a little bit more premium, but this will not be the 23% return on capital so quickly. So in this case, if we were able to close this out for a winner, because we didn't have breached the strike as bad as we did, I'd be collecting about $930 on about $4,000 of buying power, which is about a 23% return on capital. Next up is NVDA. NVIDIA, this was a pretty sweet spot of risk to reward, in my opinion. So we collected 1050, about 4.1K in buying power, which yields about a 26% return on capital. So that is one that is right down the middle, likely to pay out close to 100%. Because there's really not a lot of trading days left. Put this trade on a Monday, so I got Monday, Tuesday, Wednesday when the earnings came out. So we're looking at a 4-day trade 26% return on capital. This is exactly the type of trade I like to turn over on earnings. And so by playing enough of these earnings, you pick up enough of these trades. And then as long as you're picking your stronger underlyings that are profitable companies, they do eventually kind of come back around. You can collect dividends on the way. Target declared a $1.12 dividend for shareholders that's payable in December. And so holding those shares really isn't as bad as it sounds, because especially if you start getting your price appreciation and you don't continue to decline. Now, I don't know if that's the case for Target, but we will see. Next one was the Palo Alto. So this is one, So we collected $752 on this. Took about 3.1K in buying power. Again, that's about this 24% return on capital. So a lot of these you'll notice is in a 20 to 25% return on capital. That's kind of the sweet spot here for the premium that I'm collecting. This was a 20 Delta Strangle. And then last but not least is Snowflake. Now, again, this one is working against me, so I likely will not be able to churn this whole profit right away. Might have to work at it through a roll, pulling the put up, but I do think we will end up closing this thing out for green, but we'll see how long it takes and how much. But if it went straight through, I'd be collecting about 1052 on about 3.9K in buying power, or about a 27% return on capital. And that is basically the quick rundown of these things. And the reason I just kind of run through them is because they are the bread and butter of what I trade. Earnings season still has a little ways to go. My typical MO here is I take a look at all of the screenings for upcoming earnings of the following week, looking for the extended volatility. I mark down all the trades that I'm interested in. And then come Monday, I go ahead and try to place a lot of those trades or open up those strangle positions on the top and bottom side, which is most of the time how I like to trade earnings, because earnings are a binary event. They're very unknown. And in my opinion, the whether or not it's going to go up or down is largely a coin flip. I've seen companies that report good earnings, give good guidance, and they're still knocked down. I see companies that miss earnings, give poor guidance, and they can go up. And so I really feel the direction is kind of a coin flip. And because direction is unknown, it is more advantageous to play this on both sides of the earnings announcement, because if you only play one side, then yes, you don't have as much risk because you're only got the risk on the one side of the movement, but you also have half the reward. So risk and reward do go hand in hand. And so a lot of times, because you don't know the direction, but you know it's going to take a direction, one of your strangles will come out a winner, and the other one, might, depending on if the volatility is overstated and we stay below that, or you might get assignment. And, I'm hesitant to call that a loser. It's not what you want to have happen ideally, but you have to take consideration that assignment is a very real possibility, and you have to be okay with assignment, and you have to have a plan ready for assignment. And so if you are not ready for assignment, whether that is to own the shares or be short the shares, then you should not enter that side of the trade. So whenever you're trading the naked option, either on the put side or the call side, you must be ready to be assigned that contract. So that brings us to the end of this quick episode and the 4 earnings trades that I put out there. We'll let you know how they pan out. This week is a holiday week in the U.S., so the markets are closed, and the futures and bond markets are actually open shorter hours the other day. So make sure you check your market calendars to get the exact market hours for the exchange and stuff that you are trading in. Maybe you're going to take a little trading break this week and relax and hang out with family and enjoy the time off. So good luck out there. Have fun. And remember, think outside the block.